Hello everybody, I'm back. In this video I want to tell you about the latest dividend reinvestment that I made into my dividend growth portfolio. If you like this content, please hit the thumb up at the bottom of the video, and also subscribe to the Dividends and Income channel. We're building content constantly here, and that'll help us out. Thank you. On the screen, I need to tell you about the dividend growth portfolio a little bit first. This is your first introduction on video to it. It's been in print or online for years now. But for those of you that are just meeting me via these dividends, let's talk about the portfolio itself. On the graphic, you can see right at the top, the purpose of the DGP is, as I will abbreviate it, which stands for Dividend Growth Portfolio, is to demonstrate dividend growth investing in real life. I started this portfolio in 2008, so it's in its 13th year. It's at E-Trade. The original amount I invested in 2008 was $46,783, and the reason that's not a round number is because it was originally populated with 10 stocks, a certain number of shares of each stock that amounted to roughly equal allocation to each of the 10 stocks. But stock prices being what they are, of course the total number did not come out to an even number. After I started the portfolio on June 1st, 2008, I have never added another dime to the portfolio. No additional capital. I did that deliberately. I know it doesn't match the way most of us invest. Most of us are making, say, monthly or even weekly contributions to a portfolio, or maybe to several portfolios. But what I wanted to do was hold that number steady so that as it got older and statistics and trends started to appear, the statistics and the trends would all be related to dividend growth investing itself. They wouldn't be skewed or inflated by the fact that I was adding, say, $200 or $500 a month to the portfolio, which would bring all the numbers up, but it would throw off which of those numbers were happening because of dividend growth investing and which of those numbers were happening simply because I was adding money all the time to the portfolio. So I've held that amount constant ever since the portfolio was begun. My primary goal in the portfolio is income. As it says in the table, to build a reliable, steadily increasing stream of dividends over many years that will eventually be used in retirement. So it's an income-focused central goal with a secondary focus on I want it to be competitive in total returns with the S&P 500 over long periods of time. I'm not trying to beat the market, so to speak, in total return. I am certainly trying to beat the market in dividend return. I manage the portfolio in real time. The results are actual, not hypothetical. All the growth is organic, going back to the idea that I've never added money to the portfolio after I started it. All the results are the result of what goes on inside the portfolio. You could almost think of the portfolio as a black box. Money came in one time only in 2008, and ever since then, all the results have been the result of what happens in the portfolio. How the stocks perform, how the dividends perform, what stocks I choose to reinvest the dividends in, and so on. So it really isolates dividend growth investing as a strategy, which is the goal. It's to be an illustration or a demonstration of the strategy of dividend growth investing. I don't claim it's the best, but I do claim that it's real. This is what I've been able to accomplish, and I hope it serves actually as an inspiration to a lot of you. Here's what you can do over a period of time if you have a process, trust the process, and stick with it. The business plan for the portfolio, which I will not show you in detail today, but it exists and can be viewed anytime you want to, is to hold 20 to 35 dividend growth stocks and or ETFs and or CEFs, which stands for closed-end funds. In fact, what the portfolio has right now in it is 28 stocks, no ETFs, no CEFs. The turnover in the portfolio, which is, say, the churn rate of the portfolio, is low. Typically, it's less than 10% a year. If all I do in a year, and there have been years like this, is reinvest the dividends, the churn rate of that kind of portfolio would be zero, because again, there's no new money coming in. All I'm doing is recycling money that was in the portfolio anyway. Occasionally, and we'll get to this in some videos in the future, I will decide to make a change. I'll trim a stock because it's become too large for the portfolio, or I sell a stock because I've lost confidence in the company. When that happens, that will add to the turnover rate or the churn rate in the portfolio. But typically my churn rate is 0 to 10% a year. And on average, I say it's 6 or 7%. I think it was 7% last year. I made one set of trims and repurchases and other things, and that's what comprised the entire churn rate. Finally, as to dividends, and this will get us to the main topic of this video, which is what I just reinvested in. All dividends are reinvested other than dividends that I am accumulating for the next reinvestment. I reinvest dividends once a month. I don't drip them, so I don't do the automatic process of returning the dividends directly to buy fractional shares of the stock that paid the dividend. Rather, I collect the dividends in cash, and once a month, around the middle of the month, I pick a stock to invest in. That can be either more shares of a position that's already in the portfolio, so reinvesting dividends becomes a way to build a position, or I might pick a new stock to start a new position in the portfolio. There's room to do that under the business plan right now because, as I said before, the portfolio has 28 stocks in it and the business plan allows for up to 35. So I've got plenty of room to reinvest either way. Okay, now let's move along to the dividend reinvestment that I made in my dividend growth portfolio on Monday, March 15th. The stock I decided to buy is Pinnacle West Capital. Ticker symbol is PNW. I know that name makes Pinnacle West sound like a financial company, but it's not. It's a holding company for a utility that's largely based in Arizona. Pinnacle West is a company that I already own in the portfolio, so through this dividend reinvestment that I'm going to tell you about, it meant that I'm building up a position already in the portfolio rather than starting a new position. When I'm making a dividend reinvestment like this, I do a quick check of the company's quality using my Quality Snapshot system and of its valuation to make sure that since the last time I looked at it, its price hasn't risen such that it's too expensive to buy. Looking at Pinnacle West's Quality Snapshot, we see that it gets 22 points out of a possible 25, which is just below the top tier, second tier quality company, above average quality. I went and checked my records, and as near as I can tell, that makes Pinnacle West tied with one or two other utilities for the highest score among utilities. Utilities have a difficult time sometimes scoring high on Quality Snapshot, largely because of their capital-intensive business models, which often requires them both to be carrying high debt and sometimes also to be issuing new shares all the time. So they have difficulty scoring highly on the financial strength aspect of the overall assessment of quality. Pinnacle West, that's not true. The Value Line Safety Grade is 1, which is their highest grade. The Value Line Financial Strength Grade is A+, which is the second highest ratings. That gets a light green color and 4 points. The Standard & Poor's Credit Rating is an A-, which is a good, solid investment grade rating. Second highest tier of those ratings, so that also gets 4 points. The Morningstar Moat Rating, Morningstar generally gives no more than a narrow moat rating to any utility because of the regulatory requirements that all states or jurisdictions impose on utilities. Morningstar considers that to be a continuing risk for any utility. So I've never seen a wide moat rating issued to a utility. So they get however, the second highest rating, which is a narrow moat rating, which means that in Morningstar's opinion, they're protected from competition for 10 years or more. And finally, the Simply Safe Dividends safety grade is 92 out of 100, which means that Pinnacle West's dividend is very safe and very unlikely to be cut. The source of this price graph is Fast Graphs. I placed 2 dots on the price line to show where I bought Pinnacle West last July, which was my first purchase of it and established the current position in the stock. And the second dot to the right end of the price line is where I purchased it last Monday. I did a quick check of the valuation, and even though the price has gone up $3 a share since last July's purchase, it's still basically, the price has basically been flat over the last few months, which is fine with me. In a buying mode, you always want the price to stay flat or even go down, and I am in a buying mode in this portfolio through the dividend reinvestment process. When I set up to make the reinvestment, I had to look and see how much money in dividends had accumulated since I last reinvested, which was last month in February. I had $426. I only buy whole shares. E-Trade doesn't offer share slices, and I'm not sure that I would mess around with them anyway, because I like to keep the math simple. So I don't want to be figuring things out by using fractions of shares. So I bought 5 shares, and the total purchase price was $398 for those shares. As I'm sure you all know, at all online discount brokers now, there are no commissions, and there was no commission on this trade. The additional 5 shares of Pinnacle West brings my position total up to 42 shares. This graphic comes from information from Simply Safe Dividends, where I have my portfolio set up as a portfolio, and the site is great in terms of giving me all kinds of statistics back. What this graphic shows is my income, how the purchase of the 5 shares of Pinnacle West impacts the portfolio's whole income. Before I bought it, the portfolio had a dividend run rate of $5,062 a year. And after the purchase, after adding those 5 shares, it has an annual income run rate of $5,078. And now I want to make a little speech that you will hear from me over and over. I know this doesn't sound like much. It's only $16 a year. If you do the math, that's about 0.3% of the total income. So by reinvesting the dividend this month, I increased the portfolio's income by a fraction of a percent. I know that sounds small, but I ask you to look at it this way. If I make 12 reinvestments per year, which I do, and they each add between 0.2% and 0.3% to the annual income, that amounts to a 3% annual increase in income without me doing anything other than reinvesting the dividends. That's a really important point in dividend growth investing, so I want to reemphasize it by changing the perspective just a little bit. If every stock in my portfolio froze its dividend, gave me no dividend increases at all for an entire year, nonetheless, through reinvestment alone, my income next year or in the coming 12 months will be 3% more than it would have been if I weren't reinvesting the dividends. That by itself covers inflation. Now, of course, being a dividend growth portfolio, the stocks in the portfolio have all been chosen for the likelihood that they will raise their dividends each year. And in fact, even this early in this year, 11 companies in the portfolio already have announced dividend increases for 2021. So what I just described is not what's going to happen. My portfolio's annual dividend income is going to go up more than 3% a year. The 3% a year from reinvesting is on top of the amount or the rate that the dividend income would go up by just from the companies raising the dividends themselves. As to Pinnacle West, if it follows its usual schedule, it will declare this year's increase later in the year in time for the dividend that will be paid in December. So Pinnacle West is not one of the companies that's already declared its dividend for 2021. It will do so later in the year. And that's about all I need to tell you about this month's reinvestment. I do this every month, so you'll be seeing a video every month on my choice for the month. And as I said before, sometimes I'll be adding to a stock I already own. Other times I will be creating a new position in the portfolio. And because I don't add any new outside money to the portfolio, this is basically the only way I can grow the number of stocks in the portfolio is through these reinvestments. I will add one other thing. This reinvestment is an example of how I typically invest. I survey the landscape all the time for stocks that are a good buy and meet my requirements at the time I have the money to invest. I don't care what order I buy stocks in. I know some people approach their portfolios like they'll focus on one or two companies and say, okay, my goal for this year is to build up that holding or build up this holding. I don't do it that way. I follow stocks around seeking out good valuations and good yields and meeting the goals of my portfolio. And then I call that opportunistic investing. When I have money and at the same time a stock is in a price range and giving a yield and has the other qualities I look for at the same time, when those two things intersect, that's when I make my move and buy some shares of that stock. And that's a wrap for this video. Again, please click the thumbs up button if you like this content. Please subscribe to the Dividend and Income channel if you like this kind of content. And I will see you guys in a little while, probably about a week, with my dividend growth stock of the month for April. Bye.